Good evening, everybody. Welcome to today's webinar focused on highlighting the Indian economy, its current status, and its current currency. I'd like to take a moment to welcome our audience from all around the world, which is joining us remotely. Just before I get into the specifics of the structure of the webinar, as well as the very special expert that we have here with us today, I'll take a moment to introduce myself. My name is Ritika Mankar. I work as an economist on the sell side, but I'm here today in the capacity of being a director on the board of CFA Society India. So welcome everybody. I hope I'm able to moderate a fruitful webinar for all of you who signed up from different parts of the world. Before I get into the specifics of introducing the absolutely stellar guest we have here today, I'll just take a moment to highlight a few housekeeping rules. Today's webinar will be scheduled for about 60 minutes. So by 6:30 p.m. India Standard Time, we should be able to close. We'll leave time for a Q&A at the end of the presentation. The broad structure that we'll follow is that once I hand over to Sharmila Whelan, she'll run you through a fairly punchy presentation that she's put together for about 25 to 30 minutes. Highlighting her views with respect to the subject. We'll then take specific questions that all of you might have with respect to this clearly very, very important subject and moderate a 30-minute discussion following the presentation that Sharmila makes. The webinar presentation will be available to view after the presentation concludes in the chat box. We value your feedback immensely, and really that's what keeps us going, gives us a sense of what kind of content we should be putting forward for you. So once the webinar gets over, it'll be really fantastic if you could spare a few minutes and fill up that feedback form. So now I'll get into what everybody is really waiting for. Tell you more about our speaker, Sharmila Whelan. Sharmila Whelan is a Deputy Chief Economist at Aletheia Capital, Asia's largest independent research house, whose clients include the top 100 global buy-side firms. Previously, she's also worked with a range of marquee firms, including the Bank of America, Merrill Lynch, as well as CLSA. Only in the interest of time and with due permission from Sharmila, I won't elaborate on those details. But ladies and gentlemen, we have amongst us an economics expert who has more than 2 decades of world-class experience covering some of the most complex economies that even I have only tried to get a better understanding of. So that's it from me. I'm going to step right out of the way and hand over to Sharmila for giving her her time and her views. Over to you, Sharmila.
Thank you. Thank you very much, Ritika. That was a great introduction. I hope I can live up to everybody's expectations now that you've set them. So wait, I'm trying to get to the first slide. Why is this not happening? All right. Okay. So today I wanted to take a different view of India. I wanted to analyze India in the Austrian framework of business cycle analysis, because that's the way we look at India and all our countries in Asia. So starting off with the first slide, now the mainstream thinking, which is mostly, apologies for that, just bear with me. As I was saying, the mainstream thinking, which is mostly Keynesian in its theoretical underpinning, according to them, it is demand that is a source of economic growth. The Austrian economic outlook is very different. For us, it is, and the Austrian analysis being based on the analysis of business cycles in the real world shows that it is supply that leads growth. Before there can be consumption, there has to be production. And before there's production, you need investment and savings. In the first chart, I'm showing a very simple schematic, which I want to talk you through about how economic growth and business activity is generated. The entrepreneur, i.e. businesses, and profits play a central role in this. The starting point, it is the entrepreneur. It is the entrepreneur that recognizes and identifies unfulfilled consumer wants, i.e. gaps in the market, it is the entrepreneur, he or she, that takes the risk of investing in production of those goods and services. If his gamble pays off, he realizes a profit, and that is a signal to invest even more and increase production capacity further. This creates employment. What it also does is as businesses scale up, it drives down the cost of production, and in doing that, make the good in question more affordable for a greater number of consumers, and therefore it is expanding the market. And this is how economic activity is generated. And I would add that it doesn't stop here, because market economies and entrepreneurs do not work in silos, right? Entrepreneurship leads to more entrepreneurships. One entrepreneur action fuels further innovation, specialization, and creates the market for new products and fuels other entrepreneurial activities. This is how one business or one company grows into a cluster of businesses. And from a cluster of businesses, you go into a fully horizontally and vertically integrated ecosystem. So the point is, it is supply that leads demand. You've got to have investment in production before you can have consumption. And again, the entrepreneur and the profit motive are key. I'll turn to the second slide on this because I want to pause for a moment, and I'll get to India because I think it's important to set the framework and the thinking. I want to focus on this chart to talk about profits and the business cycle. The business cycle is made up of a number of non-coincident cycles. But the most important cycle is the profit cycle, because this drives everything. Profits drive investment, investment drives economic activity, and underpins the demand for labor. So I've taken the liberty of putting another schematic on the second slide to talk you through business cycle. In a recession, right? In a recession, companies are going bust. Companies are cutting costs, both investment and labor, because they're trying to restore profitability and repair balance sheets. The trough of the business cycle downswing is reached when profits start stabilizing. Profits start stabilizing before the economy has started stabilizing and the downturn there is over. Now, note, profits are stabilizing not because costs are being cut, not because top-line revenue growth has improved, because the consumer is still absent. We've got high unemployment, minimal wage growth. But the fact that profits are stabilizing encourages businesses to start investing in replacement capital, which is the first stage of the investment cycle upswing. This is the beginning of the business cycle upswing in general, and not just the investment cycle. So, and at this stage, the credit cycle is very weak because companies rely on their own balance sheets, i.e. retained earnings, to finance investment, which is directed at upgrading existing capacity and replacing capacity. As profits continue to improve and businesses get more confident about the future, they start leveraging up, they start borrowing to invest in new capacity. As capacity grows, this creates employment. As the demand for employment strengthens, the labor market tightens, and wages start to rise. This underpins the return of risk appetite in the household sector, and the household sector starts to run down savings and borrow to support consumption. And this is stage two. As we progress through stage two, you enter the boom. When you're in the boom stage of the upcycle, both companies as well as households are borrowing to support investment and consumption, at a rate that is higher than their current rate of growth in incomes and profits, the credit cycle is in full upswing. But as you proceed through the boom, costs start rising because companies are competing for increasingly scarce factors of production, i.e. labor predominantly. As costs start rising, this starts hitting profit margins, and profits themselves start struggling. At this stage, also interest rates are rising in response to rising inflation. In stage 3, we're in the late cycle boom. The peak comes in stage 4 when profits are falling. By this time, interest rates have caught up. Central banks might have started been behind the curve, but interest rates have been increased steadily and are catching up. Profits are falling and interest rates have gone up. What that means is that investment projects that looked viable at bottom of the trough interest rate levels no longer look viable. Balance sheets have also deteriorated because companies have piled on debt. The boom is over. We're entering the bust stage. Now, the intensity of the upcycle and the boom and the bust after that depends very much on how low were interest rates at the start, were they artificially depressed? Also, how long has a credit fuel investment upswing continued, and has it built into a malinvestment and a debt bubble? But the fifth stage is we're in the downturn again. Profits are collapsing. Companies are scrambling to cut costs. Unemployment is rising. Debt is being cut. Investment is being cut. This is very simply, in a simplistic explanation of how business cycles work and why it's very important for us as a framework for analyzing countries. But let's turn to look at our 7 Austrian stress indicators. These are the 7 indicators that we use to analyze where countries are in their respective business cycles. Starting off our 5 domestic indicators, the most overarchingly important one is the profit cycle. And for that, we look at average return on equity in the listed sector as a proxy. We also look at the investment cycle, the credit cycle. Overlaid on this is policy settings. Specifically, we look at the real lending rate, the 2-year average real lending rate, to see if capital is appropriately priced for where the country is in the business cycle. We also look at monetary aggregates, basically M2 growth, to gauge economy-wide underlying price pressures. We look at 2 external indicators, the M2 to foreign exchange reserves multiple. This is a gauge of the risk of capital flight. We also look at the adjusted resource gap, which is defined as the sum of the current account balance plus net FDI, to see from a fundamentals point of view, should a currency be strong or weak. But let's turn to India to discuss each. Turning to looking at India's profit cycle. So the first chart looks at average return on equity for the BSE 500. What you can see is that the Indian corporate profit cycle had stabilized in 2017, but went into downturn in 2018. In 2019, average return on equity came in at 8.4%, which is well below the 7-year average of 11.4%. Looking at the first half of this year compared with the same period last year, profits have continued to weaken. The second chart looks at return on equity by sector. As you can see, banks have returned to profitability. This is, for me, the clearest sign that the legacy of bad loans have been now dealt with. the IT sector, as well as the fast-moving consumer goods sector, profitability is improving, but I don't expect that to last. The COVID-19 economic shock is massive and it is widespread. It is affecting small companies, large companies, medium-sized companies, and across sectors, whether they're consumer goods or capital goods. The main takeaway that from the second chart that I'd like to highlight is what's been happening to corporate profitability in the capital goods facing industries, capital goods, metals. And as you can see, corporate profit, the cycle there was in downswing well before COVID-19 hit. Until the corporate profit cycle turns in these sectors, and a sustainable business cycle upswing will continue to evade India because household spending and government spending is not enough, as we discussed earlier. Turning to the investment cycle. So in November last year, I wrote a report on India called Breaking Bad. There we forecast that a private investment-led business cycle upswing was still another 4 to 6 quarters away for India. And this was premised on corporate profitability stabilizing in the large private sector, capital goods and investment goods facing companies, and there where signs were that the deleveraging process was coming to an end. All bets are off now. What I show in this chart, chart number 5, is our investment relative. We monitor the ratio of real gross fixed capital formation to real GDP, the actual ratio versus the trend, to look at what is happening to the investment cycle. We take also into consideration the slope of the trend line and, very importantly, the residual, as well as the absolute level of debt in the economy. Now, the residual, if the residual is, which is the dark blue line below, if the residual is below 0, it normally means that the country is in an investment recession and the business cycle is headed for a downswing. I think this chart speaks for itself. I expect the investment cycle to take another leg down as rising bankruptcies and corporate indebtedness combines with collapsing sales revenues and profits to force companies to cut back investment spending faster and faster. Turning next to the credit cycle. The first chart shows our bank credit relative. For us, this is a long-standing measure and a very reliable one that we track to see where the credit cycle is going. Again, it's looking at commercial credit as a percentage of GDP, actual, the ratio versus the trend. If the actual ratio, the blue line on top, is above trend, then we would say that the credit cycle is in upswing. What is really important at the same time is what's happening to the residual, which is a standard deviation of the actual from trend. Now, if the standard deviation is above +2, it means that the credit cycle is getting overstretched and is vulnerable to rising interest rates. If the standard deviation, the dark blue line, is headed towards 2 or below 2, that means the credit cycle is in downswing and the economy is probably in recession. What we can see from this chart for India is that the credit cycle has been relatively subdued, and really no surprise there. It's been subdued for a good few quarters before COVID-19. And as I said, no surprise there. Demand for credit given from the corporate sector has been negligible because the investment cycle is in downswing, the corporate profit cycle is in downswing, and even if the they entered the first stage of the investment cycle, the replacement cycle, that would be met out of their own balance sheets. Right? At the same time, so the demand side is weak because of the lack of corporate demand, but also it's a supply side. Remember, Indian banks have just finished repairing their balance sheets. They're under intense scrutiny by RBI, so they've been reluctant to lend as well. Question is, what happens from here onwards, right? We've seen the government announce a $277 billion COVID-19 emergency package. Now, to me, when you go through looking at the details, this looks like predominantly monetary policy measures dressed up as fiscal policy measures. And the singular purpose of the monetary policy measures is to encourage companies, and not to forget states, to pile up loads of debt. And for me, this is a big concern. And that brings me on to the second chart, which shows gross non-performing assets in the banking sector. Now, India has worked very, very hard the last couple of years and has gone through a lot of economic pain trying to resolve the bank bad loan problem, which was the overhang from the credit fuel investment super cycle of the early noughties, right? Banking sector has returned to profitability. NPLs have peaked and have been trending down. Coverage ratios have been increased sharply. Capital adequacy ratios have been increased. And this is all before COVID-19. Now, my concern is that if the emergency package, which, as I said, is mostly monetary policy measures, is successfully executed, all this good work is going to be undone. So not only are the prospects of India getting to the next private investment-led business cycle upswing receding, the risk is growing that in the interim, you get another twin debt crisis, which is led by rising NPLs in the banking sector and rising corporate indebtedness. Moving on to, so what's happening with interest rates, broad money growth, our other remaining two domestic Austrian indicators. Now, for us, the real lending rate is very, very important because it is based on the real lending rate that companies make investment decisions. So what the first chart shows is the 2-year real lending rate, right? We consider the real lending rate to be in normal range when it's between plus and minus 2%. If it's above 2%, then it would suggest that it is compromising growth. If it is below minus 2%, then the risk is of it triggering a malinvestment bubble because credit is so cheap, companies just borrow for projects that kind of make sense at deeply negative interest rates, but if interest rates were in the normal range would not make sense. So if you look at India, interest rates are within the normal range. It's probably monetary conditions are easier than what the real lending rate would suggest, simply because of all the schemes that have been introduced to extend credit to the different sectors. Turning to broad money growth, which, as I started off saying, for us is a gauge of economy-wide price pressures. Broad money growth has ticked up, but you can barely see it in that graph. So it's rising from a low base. What broad money growth trends are saying are that at the moment, price pressures remain subdued, and this has been confirmed by the CPI numbers that came out this week. Demand pull and cost push pressures remain subdued. It remains to be seen what happens in the coming quarters, but we do have a good harvest coming, which does help things. And as we've seen with the CPI, it's food prices that's mostly behind it coming down. So that's about the Indian domestic economy. In the next chart, in slide 8, I'm going to turn to our external indicators to look at what is it saying for the rupee. The first thing we're looking at is the money reserve multiplier in chart 1. So the money reserve multiplier is very simply the ratio of MTU to international reserves. Now, the logic for looking at this ratio is that in emerging markets, capital flight induced crises are normally not triggered by foreign investors fleeing the country, but by locals who get worried or react to balance of payments imbalances or fiscal imbalances or economic or political news, because they're the first ones who get the news because they're closer to the ground, and they trigger the capital flight. What the ratio does, it measures the amount of local currency deposits that can be converted into other currencies before international reserves are exhausted. If a money reserve multiplier ratio of 3 or below is considered safe. In India's case, the ratio is 1.2, so it's well within range. So the risk of capital flight is low. Looking at the second chart, which shows the adjusted resource gap, which I mentioned earlier, is the sum of the current account balance plus net foreign direct investment. As you can see, now this tells you whether the fundamentals are in support of a currency or not. If you're running a current adjusted resource gap surplus, then the currency is the fundamentals of support of a strong currency and vice versa. What you can see in this chart is India's resource gap has moved from a deficit into a surplus, which would suggest that the fundamentals are in support of a rupee. However, the reality has been quite different, which brings me on to chart 9. The rupee is Asia's worst performing currency this year. And this is not down to dollar strength. The rupee has depreciated by even more against the euro and the Japanese yen. And among Asian currencies, it's depreciated the most against sterling. It's very clear that concerns about the COVID-19 infection outbreak in India, the economic lockdown on the back of that, and worries about the economic cycle are overshadowing improving fundamentals, which should have been supportive of the rupee. We expect, or rather I expect, the rupee to stay weak, and I would not rule out further downside to the rupee given the growth outlook. Finally, in slide 10, I show the 14 macroeconomic activity indicators that we track to monitor current economic performance. This table is pre-COVID-19, and I've deliberately not updated the data because I wanted you to look at it and to look at it for the two key messages there. One is that even before the current health crisis, the Indian economy was set to decelerate further, which has been confirmed by the first quarter GDP number. Second is even before COVID-19, 10 of our 14 Indian activity indicators was sending out a negative signal, which to me, the takeaway is that the Indian economy is just not in a position to deal with another exogenous shock. And COVID-19 is a massive supply side exogenous shock. So just to wrap up, I'm sorry, I can't be more cheerful. I've been an India bull for years. I just went underweight India last year. But anyway, any which way you look at it, a recession is baked in the cake. India entered the current crisis enfeebled. The profit and investment cycles had gone into downswing. And even at that point, we were looking at the profit cycle and the investment cycle picking up with a 4 to 6 quarter lag. Now it's receded much, much further into the future. Modi's lockdown to me is reminiscent of the November 2016 demonetization. It was ill-prepared and ill thought through. The 277 billion emergency package, as we know, almost 48% of it is already funds that have been allocated previously. The actual fiscal spending is just about 1% of GDP. Understandably, the government does not have the fiscal space. Most of the measures are monetary, and the singular purpose of that is to encourage companies, states, households to take on debt. And this risks undoing all the painful work that India has gone through. And my key concern is that we're going to get another twin deficit crisis before we get to the next business cycle upswing. The rupee is weak. It's weak for a good reason. But I'll stop here and hand it back to Ritika so that she can open up the discussion for questions and answers.
Thank you, Sharmila, for a very lucid and insightful presentation. And I have to say that the piece that I enjoyed quite a bit was an alternative framework, because a framework empowers you to interpret situations which might change, but frameworks can provide you with a powerful foundation for analyzing just about any macroeconomic scenario that comes in front of you. That being said, let me just quickly make an announcement for the benefit of our audience. Please feel free to give us your questions, literally everything relating to the Indian economy that you want to ask Sharmila. I'll make sure I go through the Q&A link and highlight specific questions that you might have. So do keep sending in your questions. In the interim, while we wait for more questions to queue up, I'll highlight a couple of questions that seem to be coming our way. One of the key questions I think that is coming through in various means and ways is following. Sharmila, the relativity of India versus other emerging markets. Now, it's relatively clear that India will go through a fairly prolonged reduction in growth, a recession in the interim. And clearly a whole lot of other fundamental indicators, be it profitability for the stock market or listed companies, be it profitability for the unlisted companies, or be it the entire burden of bad debt that the banking sector is dealing with. What is relatively clear is that there'll be a fairly painful few quarters that await India. But how would you rate how India stands versus other emerging markets at this stage? Especially given your vantage point, which allows you to see India relative to other emerging markets.
Ritika, thank you very much for the question, and a very good question from the audience. Okay, so I'm an Asian specialist, so I can comment on India relative to other countries in Asia. I don't know how India's stacking up against South America or Eastern Europe or Africa. I'm sure it's doing better given what's going on in Brazil, for instance, and also in Mexico. and its interlinkages with the US and the downturn there. In Asia, unfortunately, India's probably looking the worst. The way I'm thinking about it is the factors that matter is, number one is your starting point, right? Where, as a country, what was your starting point, as in like, what was happening to the corporate profit cycle, the strength of corporate balance sheets, central bank and government balance sheets? That's number one. Number two is, did you go into full lockdown or partial lockdown, right? Number three is, if you went into lockdown, how long, right? Because the longer the lockdown, the more the chances are that demand is being destroyed rather than demand being delayed or suppressed. And the fourth thing that matters is your ability or your flexibility for fiscal and monetary policy easing, right? So if you look at the different countries in Asia, the countries that, before I start segregating out the countries, first thing to say, India versus the rest of Asia, the main hit is coming through to the rest of Asia is now through exports, right? It's coming through in the same way to India, but less so, because India is much more a domestic demand economy, driven economy, which was its saving grace in 2009, right? But this time it is its weakness, because the domestic economy is in a lot of trouble right on its own, and troubles that started before COVID-19. So it's just a double whammy. But for Asia's rest of Asia, the hit is coming through exports, weaker demand from Europe and the US, which are all going into recession. Within Asia, therefore, looking at countries, the countries that look, relatively speaking, less affected are the Philippines, right? Singapore, Vietnam, China, because it's very much a domestic demand driven country now, despite the US-China trade war, which is of course having an impact, but it has the fiscal and monetary policy firing power there. Japan, because by the end of last year, before the crisis, the health crisis hit, Japan, the growth cycle had been strengthening steadily. And this is despite two hits to the economy. One was the export headwinds from abroad. Number two was the consumption tax increase in October last year. But despite that, the underlying fundamentals were improving, that the economic upswing had broadened to encompass both investment as well as consumption spending, and consumption was being supported by wage growth. So it entered the crisis in a better shape. Again, it hasn't had a full lockdown, right? So that it hasn't had the shock that India has had, that economic activities come to an halt. So I put those countries in the countries that are looking relatively better. The countries that are looking very troubled is number one, India, Malaysia, as well as Indonesia. Malaysia and Indonesia, very similar to India, that then they've struggled to bring the COVID-19 outbreak under control, but number one. Number two is also they entered the cycle from a very weak position. Hong Kong, the jury is out on Hong Kong. Hong Kong, on the one hand, the economy is in deep recession. They're having their third wave now, and that's beginning to shut down parts of the economy. There's a rise in the political problems, and the rise in anti-China sentiment means Chinese tourists are not coming back anytime soon. But on the flip side, there's a huge capital inflow into Hong Kong, because Chinese companies are delisting from US browsers and are going to be listing on, and that helps the finance sector, which is the dominant sector in Hong Kong. Also, things like opening up the Hong Kong Greater Bay Area Wealth Management Connect. So on Hong Kong, I'd say I'm a bit on the fence, but I hope I answered your question.
Sure. And once again, I think you give us a great framework in terms of how you arrived at the conclusion that, not just versus India's own history is India looking really vulnerable at this stage, but also vis-a-vis other countries through the lens of various parameters, India doesn't look like it's in a good spot. I think I'll move on next to combine two questions, one from Prashant and one from Jatin. While Prashant is asking if there is any silver lining, Jatin is providing us a hint with respect to what that silver lining could be, which is he's asking if the direct monetization of government debt could provide some sort of support. And I'll articulate this question better. The question very simply is this, that clearly as compared to other emerging markets and clearly as compared to other developed countries, the fiscal policy response of India has been very weak. It's been lower than the median response by an emerging market. Going forward, if the Reserve Bank of India and the Government of India were to decide to start directly monetizing debt with a clear fiscal policy exit in place, thereby trying to stimulate demand at a time where both corporate and household demand isn't that meaningful. Do you think that could lead you to upgrade your forecasts with respect to growth in India in FY22?
Okay, Justin, I'm really, really sorry, but I'm going to rain on your parade here. If they start monetizing the budget deficit, which they seem to be moving in that direction, that is a complete disaster, right? Oh my God, that would be the worst thing ever, because you're simply moving the debt from the corporate sector and the private sector onto the government side, right? Debt monetization means fiscal responsibility has gone out of the window. In its wake is going to will follow inflation, and very fast rising inflation. But more importantly, it goes back, will it actually help stimulate growth, right? Two things. One is it goes back to the arguments that I'm making, that the framework we look at it, that growth, economic activity is not demand-led. Business cycles are not demand-led, they're supply-led. They're investment and production-led. They're not consumption-led or government spending-led. That could boost growth temporarily for 1 or 2 quarters at a massive cost, which is a rise in public debt and the budget deficit, which at some point has to be paid for. There's nothing called a free lunch. Down the line, it means higher taxes at some point, right? Which is detrimental to businesses and the whole economy. But it does, a temporary rise in the government spending does not generate a sustainable business cycle upswing. That's number one. Number two is look at the experience of the US and Europe since the global financial crisis and the European sovereign debt crisis, right? They've had one QE program after the other, asset purchase, which is they're not the ECB is not directly buying government debt from its member countries. Neither is the Fed buying debt directly from the government, but it's pretty much that, right? It's just dressed up as I'll buy it through the secondary market, but pretty much that. And you look at the last decade since the global financial crisis, the amount of liquidity that has been pumped in versus credit growth, right? So now don't quote me on these numbers because I'm trying to remember off the top of my head. The last time I looked at the numbers, money supply growth had increased by something like 300% cumulative over the period, and credit had grown by 60% or less. And credit is what's going into real economic activity. It's borrowing for real production, real investment, real economic activity. And it is what we've seen. Most of the money has gone into asset prices to fuel a massive asset price bubble. I mean, if you're an owner of assets, that's brilliant, but it's not really helped the real economy. So, personally, for me, if I'm very much against debt monetization by any central bank.
Sure, sure. And I think, yeah, you make a valid point that the question is not whether you do it explicitly or implicitly, not whether you do it directly or via the secondary market. The fact of the matter is that at best it can provide you a liquidity cover, but not the kind of improvements in the real economy that you're really looking for. That's the core point that you're making. The next question I'm going to raise.
Can I just add one more point?
Sure,
that
go ahead.
over the last 10 years, the US, despite all the QE programs and money pumping into the economy, has grown by 1.8% per annum on average. That tells you something, doesn't it?
Sure, sure. Right.
I'm sorry, I interrupted you. Please.
Sure. Point taken, and that's a very valid point that you make, that look at how wide the wedge between the pace of growth of liquidity is, how slow credit growth is, and how much slower real GDP growth is. I think that's a very valid point you make. The next question that I'll raise is from Vidhu Shekhar, who's incidentally our country head for the CFA Institute.
Thank you for the warning, I'll be careful.
And he's put his question here in the question queue. The point that he's raising is, what's the counterfactual for the 277 billion emergency program if it were not there? What is the alternative that really India has at this stage? And you know, if I was to just elaborate on his question, I guess the point that he is making is that globally, country after country, be it developed countries or emerging market countries, are essentially responding to the crisis, not just by looking after the healthcare aspect, of course, but then also administering a combination of fiscal policy and monetary policy related antidotes. What is the correct prescription, in your view, to free or redeem India from the growth quagmire it finds itself in? If not what we have done so far, and if not things like monetization of debt that some participants also seem to be suggesting?
I mean, that's a very, very good question. And you know, I'm very, very sympathetic, right? Because I don't think India had a choice it had no choice but to go into full lockdown, right? Because the health sector, they don't have the capacity to deal with a huge outbreak as we're seeing right now. So I think they had no choice but to go into a full economic lockdown. My quibble is about it was ill-prepared and ill-thought through, and that's what's reminiscent on the demonetization. Overnight, you know, 99% of the money supply disappears, and the people that are hurt the most are small businesses, the backbone of the economy. With lockdown, India had just come out of a 12-hour voluntary curfew. Within hours, they go into a 23-day lockdown. You know, there was, you know, things like, you know, there was no time for businesses to prepare. You know, the whole problem with immigrant laborers being locked out and then leaving cities to go back home because they can't live, right? That's kind of contributed to the spread of the infections. I think they would have, the government would have been better off to have waited, you know, a week, 10 days, get the support systems in place before locking down. I don't think 7 days would have made such a difference versus the massive economic cost that the country is seeing right now. But, you know, I think they have no choice. They had no choice to go for full lockdown. Number one. Number two is I'm also sympathetic that they had to rely on monetary policy measures as a part of the emergency fiscal response, because there is no fiscal capacity. So, you know, what would have been the alternative solution? You know, I don't know. Because the policy options are very, very limited, right? You know, India's not like Singapore or Hong Kong, which have got massive fiscal surpluses. They are not a closed economy like China. Then, you know, so I don't think India had many choices. It's just very, very unfortunate timing because India was just emerging, and it's just one of those exogenous shocks that happen when you don't need it and don't expect it.
Yeah, agree. I think extremely complex spot, and all that you're suggesting is that there were quite a few self-goals that could have possibly been avoided and probably resulted in us being in a better spot today than we currently find ourselves in. I'll raise the next question from the audience, a gentleman called Jolly B, who's asking, do you suggest that the Indian government should purchase private debt, especially that of lower rated companies? Do you think that's some sort of way of lending a boost to the Indian economy?
Charlie, I mean, the government, the RBI is already, and the government is already through the RBI buying corporate bonds, right? I think they will buy corporate bonds increasing of lower and lower credit grade. It gets liquidity to these companies, right? At a time when profits have pretty much vanished, the sales growth outlook is dire. It gets them liquidity to stay afloat. But it's the question that we're facing in the UK, right? That there's been the furlough system where the government pays 80% of your employee wage bills, and they're extending bank credit to keep you as a company afloat because of working capital. But it's about how long can you continue that for, and that's all you're doing with that is you're delaying the actual crunch. So I think the crunch is unavoidable. The how hard it will bite depends upon going back to fundamentals. Where did you start? Where were you when you entered the cycle? Were your corporate sector balance sheets pretty strong? So if you look at Japan, Taiwan, Singapore, strong cash balance sheets, and we're not just talking about profitability, we're talking about things like low debt levels, a lot of cash on balance sheet, free cash flows, so they've got more cash buffers. So it again goes back to where did you start?
Sure. That makes a lot of sense. I'll raise, I guess, the last or potentially the second last question from one of the members of the audience, who's bringing in the geopolitics picture here, and rightfully so, given that we have an Asia expert with us. Do you think the geopolitical situation gets trickier going forward, particularly for India, given that the relationships it has with its existing neighbors are not exactly cordial at this point in time? And if so, do you think the Indian government might in fact respond by increasing its defense budget?
Wow, I think the Indian government is under pressure to increase its defense budget, especially with China on its borders as well as Pakistan, and Pakistan getting increasingly aligned with China because of the CPEC, the China-Pakistan Economic Corridor, which is an integral part of the Belt and Road Initiative. So Pakistan has, it has said about 4 years ago, they've told the US that, you just use us when you need us. And they've, very clearly they are aligning with China, right? So India is kind of, in a sense, surrounded, right? Especially when you take on board also Sri Lanka, right, and the Chinese presence there. So I think India has no choice but to increase its defense budget. Question is, can it afford to? Will it be able to find the money to increase its defense budget over the next 2-3 years when the economy is under so much pressure and Modi has an election to win, and this election is going to depend on him delivering jobs to the young and delivering prosperity, and that makes a case for the RBI monetizing the deficit even stronger, because it takes the pressure of the government in terms of the fiscal capacity to deal with their internal economic problems, but also allows them to kind of keep a reasonable pace of increase in the defense budget. How are regional politics going to shape up over the next, 2 to 3, 5 years? I think it's very much driven by US-China relations, and on the back of it, who aligns with who, right? And also who wins the US elections, whether it is Biden or Trump. The Chinese want Trump to win, right? Okay, let me step back. So the war between the US and China is not a war about trade or technology. It's a battle for economic supremacy, right? The Chinese have been preparing for this for years and years, ever since 2009. Their two main defense strategies, or the cornerstones, are the Belt and Road Initiative and the Greater Bay Initiative. The Belt and Road Initiative, as we know, is about uniting the Eurasia landmass and expanding the market, right? Through deeper regional cooperation. The Greater Bay Initiative is about creating, in the Pearl River Delta, indigenous hubs of specialization, innovation, and advanced manufacturing modern services. Now, so those are in play anyway, right? With COVID-19 and the economic recession that is coming globally, one thing is a given. The outlook, geopolitical outlook, might be uncertain, but one thing is given: the Chinese are going to only step up their efforts there, which has got implications for India. But coming back to the US side of who wins the elections, if the Chinese would want Trump to win, because they know this war is going to continue, and instability on the back of that is going to continue. That's a given, because it's a bigger war. But at least Trump is a deal maker, right? And has no ideological leaning. So it's a bit of a case of better the devil you know than the devil you don't, right? And also the other thing is, if Trump wins, transatlantic relations between Europe and US will stay fragmented, right? And that increases the chances of bringing Europe into the Chinese sphere of influence, because they need it for Belt and Road. If Biden wins, transatlantic relationships will repair, right? And then you'll have Europe as well as the US as a common front, restricting the flow of technology to China, which really damages their long-term plans, right? Especially Greater Bay. So that's the kind of the back set that I see, right? And the moving pieces within that. Now, where does that leave India? Right now, okay, the skirmish we've seen with China and India on the border. Again, we've seen China flexing its muscles in the South China Sea with Taiwan. Of course, we've all know about the Hong Kong National Security Bill, but that's a different matter. It's a special case. Part of it is opportunistic. Right. Hong Kong, Taiwan are special cases, is a different case. But with India, I think it is opportunistic, because India is distracted. I think India has responded pretty strongly, partly because it's threatened, but also to distract from the domestic problems, which is what happened during the elections, right? The 2019 elections. So I don't know whether I've answered your question, but I've just given you a long convoluted picture of the world. Sorry.
Right. No, this is very useful, because I guess there are no black and white answers when it comes to geopolitics. And you highlighted to us the moving parts in the jigsaw puzzle, which in turn will give us a nice way to think through what happens to India. A lot of the antagonism that India has been at the receiving end of is a function of US-China relations, and a big decider in terms of which direction do these go will be probably determined in November of 2020. So that's again a very useful framework, I must say. With that, I think I shouldn't take more of your time. The questions continue to pile up, but we have to do justice to the fact that we've already taken 60 minutes of your time. So with that, ladies and gentlemen, I'll proceed to conclude today's proceedings. First and foremost, a big thank you to Sharmila Whelan for spending time with us, being so generous, not just with her time, but also her insights, which have been truly remarkable. Also, a big thank you to the audience for dialing in. These are tricky times. We're all juggling a whole host of things, and we value the fact that you decided to spend the last 60 minutes with us. Just two more housekeeping announcements before we conclude today's proceedings. Firstly, as a reminder to our listeners, please do complete that evaluation survey that I highlighted to you earlier. 2 minutes of your time is really, really valuable to us and guides us with respect to future content. Number two, CFA Society India members may claim professional learning credit by logging in their online professional learning tracking tool. So with that, I'll request the team to call the webinar to a close. Thank you to the audience, and thank you, of course, to Sharmila once again.
Can I also add my thanks to Ritika, first of all, and to the audience, some really, really good questions. Clearly, food for thought, but thank you very, very much for listening and dialing in.
Thank you.